Well, Jeff Taylor joins us now, founder and managing director at Digital Risk. And Jeff, welcome, good morning, and thank you for joining us on the show. It's certainly been an interesting 24 hours as we look at the wash-up from the Fed minutes that some of the participants were concerned about the impact of banking turmoil, yet we've got this data piece telling us that core CPI remains a challenge. What's the playbook for the Fed from here?
Well, thank you very much for having me today. So look, the fight on inflation is starting to work. As we said, year over year, we've got core CPI down from 6% to 5%, and we have core CPI at 5.6%. Now, again, this probably is still far from what the Fed wants at 2%. So as we look at the May 3rd Fed meeting, probably going to see a 25 basis points rate increase at that point. And then rents are still 8.8% of CPI, which is stubbornly high currently, as we would like it to be.
Jeff, if we take a look at the impact of the banking turmoil in recent weeks, there's still a big question mark. I mean, Jay Powell back in a news conference was effectively saying that there should be some tightening credit conditions that may do the job for the Fed, but that if it didn't happen, that the Fed might have to do more. You've been looking at this through the lens of the housing market. How much tightening do you think we're going to see in some of those lending standards, willingness to lend out to consumers because of the hit to the banks in recent weeks?
You know, it's a really good question. If you would have gone back 45 days ago, so in the U.S. housing market, there's two ways to look at it. If they're selling a conforming loan that can go to Freddie, Fannie, or FHA, I think the business is still, that's not going to be effective, okay? But if you're talking about putting stuff on balance sheet, which is a home equity loan or jumbo products, those have compressed over the course of the last 30 days. And we're seeing everybody, big banks, take a look at their lending standards and compress them to make sure they have enough liquidity, God forbid, should they need it on a moment's notice. So we definitely have seen a change over the last 30 days. And I think that we're going to continue to see that over the next 4 to 6 months until there's a sense that we're sort of on global stable ground with regards to the banking sector.
Jeff, as you've pointed out, one of the big differences in this report from the previous one was the change in the energy price. Unfortunately, since then, we've been overtaken by this OPEC cut. And if you just look at Brent, we're up 18% on the month so far. If we now think about what the next inflation report is going to look like, we've had a reversal then in the energy price, the headline oil price. We've also had a reversal in used car prices, it seems to me. Should we be concerned that actually we're going to get a re-acceleration on headline?
You know, I think as we look at going forward right now, I think it's not a re-acceleration on headline, but if I bring this back into the housing market, you know, when people are looking to buy a house right now at an interest rate of about 6.5%, they can still put 5% down from an affordability perspective. And if that household is making $97,000, they can get into a house. I don't know anywhere else in the country where you can put 5% down and get into a house with that kind of an income level. That's an income level. So from that perspective, I think it is still very solid.
It's interesting you make that point because, you know, much of the focus on the wash-up on the banking sector at the moment is just on how much tighter credit conditions and lending standards are going to be from here on in. And I still feel that we're not really out of the woods on this story yet. Do you anticipate that those lending requirements are going to get tougher here as we begin to understand just how deep the problem is in the regional banks?
I do. And again, I'll just kind of repeat this, but I think from the housing market perspective, and I'll go broader. From housing, it really comes down to if these loans have a place for a takeout, right? Like I said, back to Fannie or Freddie, I don't think that the lending standards are going to change that much from a U.S. housing market perspective. That being said, anything going on balance sheet, right, whether it be a credit card or being an auto or home equity, that is drastically changing for all the reasons you just said, especially on the regional, especially for regional banks who have obviously there's more concern around their liquidity. And again, it's where they have inverse interest rates right now, where they put money to work at 2% and they're paying off at 4%. So all those are coming back to still having a concern as far as to putting new assets on balance sheet right now.
Jeff, we've been having a debate as to why demand isn't cooling at this point, the wash-up of all those COVID trends still. But we've still got a resilient labour market, which may be fueling some of the consumption we're seeing out there. It's just not happening necessarily in the housing market. As you point out, that we're still at a very interesting point when it comes to what those housing loans look like at this stage. What comes next? Because if housing loans and the rates come down again, even if we're looking at a recession, what does that do if the labour market remains resilient?
It's a great question. And I think the big factor there is over the last decade, there was about 6 million houses we didn't build in the U.S. So when you take a look at how tight the inventory is, it's still incredibly tight. And then so you take a look at what's the seller buyer scenario here. All right, over in 2023, people who have been buying houses, when the interest rate gets around 6%, they get active in the marketplace. And for a seller, they get active when it gets down to about 5.2 or 5.9. So the math kind of works like this. If I'm a seller and I want to buy a new house, I'm going to have to be able to put down a larger down payment at a 6.5% interest rate in order for the math to work for me to get into a new house.
So as we think about asset allocation at the moment, Jeff, I mean, what are you considering at this stage? There's a real battle going on here between the fundamentals and sentiment, and I just wonder, how you see this breaking down here, because we still need a bit more clarity about the resilience of the labour market. We need a bit more clarity about the Fed's intentions and about inflation. But money doesn't sit still, so you've got to make some calls.
Look, I totally agree. Again, from the housing market perspective, look, structurally, we are very sound. And the reason I make that comment is some people have said, like, well, is the housing market heading back for in the U.S. like a 2008 financial crisis scenario? That's not it. So I think from a housing market, from a delinquency rate, we are still very strong. When I look at other asset classes, from an equities perspective, I think you're going to still see a lot of volatility because it's going to be a kind of that chain event where, for instance, if you have a big issue in the banking sector, it could bleed over into autos, into other areas. So again, I think we're in for the next 6 to 9 months. I think it's going to still be, a very tenuous, nervous type situation. But again, if I come back to the fundamentals, especially the housing market, I feel extremely, extremely good about the U.S. housing market going forward.
All right. Well, very nice to have you on, and thanks for getting up for us. I know it's very early there or very late, depending on how you run your life. Jeff Taylor, founder and managing director at Digital Risk.